everybody, it's Jeff Gibby over at MetaStock. Thanks for coming. I hope you're doing well tonight. I want to say thanks for spending a little time with us. Today we have a special guest, and I got a little, as always, I've got a little bit of a story about him. But before we get there, let me go ahead and read this out loud to you. I know this is your favorite part, so we'll do it first. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock should have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So, Dave Landry. Let me tell you a little bit about Dave. Dave is an interesting guy. I'm sure his presentation today is going to be really, really fun. I had to say that one of Dave's done about, I think, 3 or 4 full-size books. They've been translated into about 6 different languages. But one of the favorite books that that he's developed, I don't think he published very widely, and it was called The Idiot's Guide to Trend Trading, and it was 3 pages long. On the first page, it just had an up arrow and said uptrend, a down arrow and said downtrend, and on the third page, it had a sideways and it said no trend. And so that's kind of a little bit of the personality you're going to get today. It just made me chuckle, and I remember that very, very distinctly. So the story about Dave and I were talking earlier this year, I think in January. And we were talking a little bit about, he's talking that he wanted to basically include some of his systems that he's published in his work. And we talked about kind of some of the best ways to do that. And we just got him ready. We decided to include him in MetaStock. So that's kind of the genesis of where everything has gone through. I've known Dave for a number of years, super nice guy, great presenter, does a lot of talking. And I'm going to basically get out of the way for him. So, Dave, let's go ahead and bring you on.
Okay.
Did I get the name of that book right?
It's actually the now you confused me. I think it's the Ultimate Guide to Determining Market Trends.
Yeah. Okay. I didn't think I had it right. Anyway.
Yeah, and I have about 1,000 of them here, so. Yeah, I need to figure out a way to ship them out, but I never get around to shipping them. But I usually give them out when I'm in person.
Yeah, I remember you handed it to me at the New York Traders Expo, or maybe it was in Vegas. I don't know. In any case,
yeah.
I just turned the projector over to you. I'm going to let you know when we can see you. What do you want to tell us about you?
Oh, I think you did a good job. I just hope I can live up to your everything you just said.
All right.
Looks like I've got it up and running. So whenever you're ready, I'm ready.
Go for it. It's all yours.
Okay. Today we're going to talk about my expert advisors in MetaStock, and there's also some really cool templates that I'm very excited about, and all of these are also explorations. But today we're going to focus mostly on the expert advisors. I just want to thank everybody for coming today. I really appreciate you taking time out of your busy schedules to be here, so thank you. And if you're watching the recording of this, I'd like to also thank you. I want to thank Jeffrey for making all this happen. He worked really hard to make these indicators happen. And also William Golson worked his butt off on these indicators, and he had to put up with me. And I wasn't that easy. I'm not as easy going when I'm working on a project like that, because I wanted to make sure we got it right because my name was on it. So thank you, William, for that. I really appreciate it. There's my disclaimer screen. You can go to my website and read it if you get really bored. I don't know if anybody's ever read one, but there is some interesting things in there, such as if you smoke after sex, you're doing it too fast. I like to usually use a short version of my disclaimer, which I stole from my friend Greg Morris, which Jeffrey also knows. He's a fun guy too. All predictions about the future, and a lot of stuff can happen between now and then. Now, I'm going to present a lot of information to you today, and I have really had a hard time just boiling all down to just what I'm going to show you today, because I had so much I wanted to talk about, but Jeffrey gave me a time constraint, and he knows that you wind me up and it's hard to stop me, so I have to stick to the time constraints. But look, it's not one and done. if you go to my website /ms16 and put your information in, I have tons of information. And Jeffrey mentioned those 3 books, not the short one that's only 3 pages long, but 3 real books. You can get those for free. I'll send you a promo code and you can get them off my website absolutely free. It's a $100 off promo code. The books are $27 each, and the code is reusable. So you can do that. At the end of the webinar, I'll come back to this and I'll tell you a little bit more about that. But I'll also give you 4 videos from the Trading Full Circle course, and you'll see that I borrowed heavily from that course for this presentation, and a whole bunch of other stuff, including, I think, maybe 7 free reports total. And also, people always ask me for my slides, so my slides are included in all that. So tons and tons of information to get you up and running, absolutely no cost on that. I also do a weekly webinar each week, and if you need to contact me, you can contact me at that address, and that's just to get the spam out, and I'll give you my private email once you do that. Now, a little background about me and MetaStock, just real quick. I started using MetaStock, oh geez, it was probably 30 years ago. I don't think Jeffrey was even born back then. That might be a slight exaggeration. I think he was just a little fellow when I first started using MetaStock back then. I was able to get a picture of him. And it looks like he's got the same haircut today. Now, in all seriousness, this really is a bit of a pinch me moment for me. I'm very, very excited to be here, and I'm actually a little nervous because I remember when I first got MetaStock, I just tore through everything. I even bought what's called the Technician, which I don't think is available anymore, but that had like 100 and something years of market data, and I went through all that, and I went through every indicator. And this is really a pinch me moment for me. I'm that excited because I never dreamed back when I started using MetaStock that 30 years later, or however long it's been, that I would actually have my indicators in MetaStock. So I'm really very excited about that. And these indicators I'm really excited. I'm so excited about them, as you can tell. Jeffrey, what are we charging for these indicators?
Yeah, they're included.
What? They're free? Oh, I guess you can't beat that. Getting back to my initial foray into MetaStock, I did go on a holy grail hunt like most of us go through. And I tried to use every single indicator and sometimes all of the indicators. And I found that through my holy grail hunt, I reached a point of confusion. Now I do complete presentations where I really focus on the holy grail hunt. But the bottom line is, I find that when you begin to peel away some indicators, except just a few that you use, and I mostly just use moving averages in a blank chart, and I'm going to show you how to use those in just a minute. I think the true enlightenment begins to come in. So basically what I want to do, like Jeffrey pointed out in my little 3-page book, is how do I make trading simplified? And I decided to go ahead and trademark that because it pretty much is the essence of what I do. Now, we're obviously going to talk about the methodology today, but whenever I go to present a webinar or speak in person, they always want to know about the methodology. But the reality is psychology and money management are also very important. In fact, if I had to start over, or I could go back and talk to that young pump version of me, better put it that way, if I could go back and talk to the younger version of me, I would say, look, get your psychology down first, learn a little bit of money management, and then worry about the methodology. Now, we're here to talk about the methodology, so what I would suggest you do is just find one thing that I do that strikes a chord with you, and then take the ball and run with it. Become successful at that, and then if there's something else that I'm doing that makes sense, then slowly incorporate that into what you're doing. Now, we're real quickly, when it comes to trading, you really have to approach it holistically. And by that, I mean mind, methodology, and money management. It's like a 3-stranded cord, or 3-stranded rope cannot exist without one of the cords. And the great thing is, if you get better at any one of these, you get better at all 3. So again, you want to approach trading holistically. I'm going to slip in a little bit of money management and maybe even some trading psychology as time allows. But obviously, we're going to focus mostly on the methodology today. Couple things, it's not my way or the highway. I know there's a lot of ways to trade. I am a little opinionated here and there, and some of those opinions will come out in a few minutes, but I realize there's more than one way to trade. If there's something you like what I do, again, use it. If not, toss it out. It is repeatable. By that, my indicators are fully disclosed. As I said a few minutes ago, I'll give you my slides. I'll even give you my first 3 books. There's nothing magical that I use that's not in the books or in my courses or anything else. So nothing is proprietary. In case I get hit with a beer truck, you'll have everything you need and you can do it. The other thing about repeatability is I've been involved with websites for a long time. I think DaveLandry.com was started in 1999, but I was affiliated with a much larger website at the time, and I had some other websites. And I know that repeatability can be frustrating for people. If somebody's using a proprietary indicator, it's very hard to know exactly what they're doing and when they're doing it. Or if there's somebody who's day trading, by the time, if you're trying to follow them, that is, nothing wrong with day trading, but if you're trying to follow them, by the time you're getting in, they're already getting out. And that, whether it's disingenuous or not, that seems to cause a lot of problems. If you Google if you do a little Googling, you'll see that comes up quite often. It's also conceptually correct. There's a psychology behind every pattern. And I'm going to show you a little bit of that psychology in the patterns when we get to things such as TKO. If I observe something in the markets and I can't explain why that's so based on a psychological basis, then I just simply toss it out. Now, I take a very simple approach to the markets. And again, I had to go through this grill hunt where I did try to take MetaStock and throw every indicator in the world on the chart and reach a point where I could no longer see the chart. And I realized that, wait a minute, this is not working. I'm ending up with an analysis paralysis. So Occam's razor comes to mind. One should not increase beyond what is necessary the number of entities to explain anything. And then Leonardo da Vinci said, simplicity is the ultimate sophistication. Now, when you boil it all down, you're either a trend follower or you're not. And if you're not, a new trend better develop soon. So if you're trading reversion to the mean, which that's one of the things I'm a little opinionated about, don't believe in, had some really bad experiences there. That's a 2-drink minimum on those stories, but I'm just not a big fan of it. So if you're fighting the trend, a new trend better develop soon. And the other thing too is virtually all complex systems can be boiled down, I hope that's not a margin call, to simpler systems. And if somebody shows you amazing results with a system, a lot of times they have successfully curve fit their system, intentionally or not, to the backward data. And I did a lot of mechanical testing early in my career, so I know how all that works. And all that mechanical testing actually made me a discretionary trader. I truly believe that you cannot describe a trading system on a cocktail napkin, then you should toss it out. Now, here's the thing. Now, this is a bit of a Captain Obvious, and usually in some of my presentations I actually have Captain Obvious pop up. But if you buy a market at A and you sell it at B, if B is higher than A, then you make a profit. I know, Captain Obvious, right? But from A to B is a trend, and the same thing happens on the short side. So my argument is, why not just be a trend follower all the time? Further, the only way to capture a trend is through price. So focus on price first and foremost. Now I'm going to show you some really cool moving average patterns that I'm very excited about, but also make sure you look at a blank chart before you start adding the moving averages on. Now again, I keep it simple. Other than the moving averages, I use a blank chart, occasional moving averages. This is literally the back of my business card, and it's also part of the ultimate guide to determining market trends. I think that's the actual name of the book that Jeffrey was mentioning. And once again, more complex system can usually be boiled down to less complex systems or simpler systems. A lot of times I'll be in a presentation and there'll be 100 buy and sells on a chart, and there'll be like a simple moving average plot or something. And just using that moving average, you could have eliminated nearly all those buys and sells and maybe just had one buy and one sell. And I would encourage you, when you pay attention to presentations, notice that. See if there's somebody with a whole bunch of buys and sells and a moving average plotted, and you'll be surprised at how something simple like that can work. Now, just to give you an idea, this is the short Reader's Digest version. I believe that through a hybrid money management approach, you can have your cake and eat it too. There's not enough time to get into it today, but if you check out my YouTube channel or my website, you'll see a lot of presentations on this. You can only predict the short term when it comes to the markets, but longer term is where the money is. Unfortunately, longer term is where your big risks are, and then shorter term, something bad can still happen. So you're sort of faced with a dilemma. And the way I solve for that is through a hybrid money management where I trade for both short-term and longer-term gains. We're going to take a look at the setup in just 1 second. But the idea is to capture a swing trade profit. In this case, it took us a little while, and we took off half the position, and then we trail a stop higher in the remainder for hopefully a long, long time. I'm slotted as a swing trader. I have the word swing trading in 2 out of 3 of my books. But the reality is, and has always been, that I'll stay with a position as long as it moves in my favor. Sometimes that can be as much as several years. Now, I like to see it as changing hats. We're starting off as a trader because you can only predict the short term when it comes to markets. Very, very hard to predict the long term, but you can become a trend follower through the money management by a trailing stop. And it's as simple as that. You let that trailing stop widen out. And again, there's not enough time to get into a lot of detail on that, but if you go to davelandry.com/MS16. Once you put your information in, you'll be taken to a page that has 3 free reports, and that's going to cover the basics of the methodology, the money management, and the basics of trading psychology. And that'll get you up to speed. Now, I'm not a big fan of reversion to the mean trading, as you can already tell. And the reason is, if markets just did this, that's great. Unfortunately, they occasionally do this, or they do that. You occasionally have these black swan events. And what happens is you make a little, make a little, make a little, selling it high, buying it low, right? And then, of course, you eventually get whacked when it's like metaphorically walking the dog on a leash. When the dog sees a squirrel, whatever, it takes off running. When that leash breaks or gets out of your hand or whatever, that's when you get into a lot of trouble. Now, somebody once told me I'm actually a reversion to the mean trader, and after a little bit of banter back and forth, I came to realize that I guess I am, but I'm doing that within the direction of the trend. So I'm looking for that bounce back in the direction of the trend. So let's take a look at that. Now, I'm not looking to buy when the market begins to drop. Okay, I'm metaphorically not trying to catch that falling knife. What I am doing is waiting for that market to rally, and I'm buying on strength. And hopefully, and I know you should never use the word hope in this business, but hopefully I get that bounce back to overbought. I'm able to get a little profit out and then trail a stop higher. Now, that reversion to the mean in the direction of the main trend is fairly certain. Nothing is certain in this business. As I often say, no one knows exactly what a market will do. Not me, not you, and not the guy who screams on TV. But this is a fairly certain move if you pick your setups carefully. But the longer term trend is a bit of a question mark, and that's why we use the money management to get into the longer term trend. So here's the whole methodology pretty much in a nutshell. We're looking for mostly pullbacks or pullbacks related patterns. There are some transitional patterns we'll get into in just a few minutes, and I'll show you what those are. We're looking to enter if and only if the trend begins to resume. We know that we could be wrong on any trade, so we are going to use a protective stop. If we're blessed with that short-term profit, we're going to take partial profits. In this case, it's going to be half and trail that stop higher. And again, the details will be in that report. And then as the trend moves in our favor, we're going to begin to gradually widen that stop and again, metaphorically change hats from the trader to the longer term trend follower. So let's talk about getting aboard established trends first. Now, generic pullbacks is probably the crux of what I do. And when William and I were going back and forth on how to define trend, what I told William is, look, I just look for, when I'm scanning, I'm just looking for a market making new highs and then a pullback from that high. So what he did was he put in various new highs. I think this is a 6-month high here, and this one here is a 3-month high. So in addition to the new high, I want to eyeball a chart and make sure there's a serious trend. We didn't want to use ADX or anything else because, number one, I'm not actually using ADX. I put a little bit too much emphasis on the ADX in my first book. I was just showing it as a tool, but I actually don't use it at all. And I just look at where a market was, the net change, and where it is now. And then I'm looking for a pullback once I establish that trend. I believe if you can't draw a big blue arrow on the chart in the direction of the trend, then it's not a trend. So it should be obvious. So that's just a generic pullback. Here's another generic pullback. You can see it's in an obvious uptrend, and then it begins to pull back from that uptrend. And again, this is just generic pullbacks in the new MetaStock. So it pretty much all boils down to identifying an existing trend or a significant change in trend, which we'll get to in 1 second, an emerging trend, entering that trend in a pullback, and of course, money and position management. And above all, having the psychology, the ability to execute and follow the plan. See, there's that little psychology. I told you I'd sneak a little in. Now, there's 3 phases of trend. We just talked about a trend resumption pattern with a pullback. There's also trend acceleration and emerging trend. Ideally, when you're trading the pullbacks, you also want to look for some acceleration and persistency. In fact, there's a pattern called persistent pullbacks. I'd recommend you learn that in addition to TKOs, which I'm going to show you in just 1 minute. And then there's emerging trends, which we'll talk about quite a bit, where a market begins to bottom out or top out, whatever the case may be, pulls back a little bit, and then begins to take off in a new trend. Now, before we get into moving averages, you must view indicators as illustrators. Price is the ultimate indicator. What is. An indicator is derived from price, and it does not actually predict. People say, oh, my indicator predicts this. No, it does not predict anything. It simply shows you what's already in the chart. So if you look at a chart like this, you'll say, okay, that's in a pretty darn good uptrend. But when you put some moving averages on there, you'll say, wait a minute, I noticed that these moving averages have begun to turn down. It looks like they're getting ready to cross over. Maybe there's something wrong with this trend. And then when you look at the chart, it's like, aha, well, yeah, it is going down. Notice the net price move from here back to here. This market looks like it could be in the process of rolling over. So indicators are absolutely wonderful, but don't use them as a crutch. Use them to help you illustrate what's already in the chart. Now, back in 1995, I'm dating myself here, I wrote an article for Stocks and Commodities magazine, and somebody who read the article called the concept, which we're getting ready to look at, daylight, meaning that there's daylight in between the moving average and the price. And in more recent times, one of my clients renamed it DaveLight. And I think that we were supposed to name the indicators DaveLight and MetaStock, but by the time we got released, they came out as just daylight. So you'll hear me use those 2 terms interchangeably. So daylight or DaveLight is simply the lows are greater than the moving average for uptrends, and the highs are less than the moving average for downtrends. So this is what that looks like on the chart. This is upside daylight. The lows, again, are greater than the moving average. You could basically draw a line or draw an arrow if you wanted to help you illustrate DaveLight. So you can see here these lows for this entire trend here or above the moving average, and now we have a downtrend beginning, and the highs are below the moving average. Now, as I said a second ago, indicators can have lag, but the beauty is by combining price action with an indicator, in this case, moving average, it takes out some of that lag. So we're not going to sit around and wait for some sort of moving average crossing or even for the slope to change in the moving average. If we begin to have some daylight, then we know that the trend may be developing or has established. So let's use the concept of daylight, and we'll take a look at kiss my goodbye. Now, all we're using with this pullback methodology is we're looking for daylight to occur, and then we're looking for pullback. Now, I am a discretionary trader, so yes, we had the daylight back here, and we had a pullback to the moving average, but this didn't look like that great of a trend to me. But over here, notice that the trend's accelerating higher, and it's also a fairly persistent one. Notice that it goes up day after day after day. And you can read about that again in the books that I mentioned. That's called persistent pullbacks. And once we get a intersection of the moving average, then that's when we have a setup. Now, two things, again, make sure that trend is meaningful, and number two, make sure that you get a pretty good pullback when it crosses that moving average, and that's where you use a little discretion in there. Now, with DaveLight pullbacks, it's the same exact thing, except I'm using a 20-period exponential moving average. And again, everything here I took straight from MetaStock, and these are actual signals. But you can see, notice that you had that nice daylight, and then you had this pullback to the moving average. So it's a very simple setup. And again, this one uses a 20 EMA, and the other one just uses a 10-period simple EMA. Now, let's get back to a price-only pattern. This is probably my all-time favorite pattern, especially when you combined it with persistency. And all we're looking for is one, a strong trend, and two, a knockout type of move. And I'm going to walk you through that in 1 second. So again, strong trend, a sharp sell-off, and you're looking to buy above that sharp sell-off. And in some cases, if that bar is wide enough, you could put a stop right below the low, and that actually gives you your entire money management, your entry, your stop, and then you do a calculation, entry minus stop, and add that to the entry, and that gives you your initial profit target. Now, no need to write all that down. I have all that in the report if you download it on my website. So when you break it down, again, strong trend, you should be able to draw a big blue arrow in the chart. And then you're looking for a sharp sell-off or a wide range bar down. And then look to enter if and only if that trend begins to resume. And then in some cases, you could put a stop right below the low if the market has a fairly sharp sell-off. In other words, if it does trigger up here, this is so far away that it shouldn't drop past that level. Now, I'm not going to go into a lot of details on the lack of entries, but one thing to know, a lot of times these setups never trigger because that sell-off is the beginning of something much bigger. And that's the beauty of it. The secret to trading is missing as many losers as possible. Now, again, everything I do has a psychological backing to it. So there's a psychology behind this pattern. Those late to the game tend to be the last in and the first out. And those Johnny-come-latelys can wreak havoc on your positions. These are the traders that have very little staying power, either through patience or through very little money or some combination thereof. And they're quick to dump a market as soon as it begins to sell off. And sometimes their selling can exacerbate more selling, and then bigger traders get sucked in and knocked out. And that's why I call it a trend knockout. So you're knocking these players, are getting knocked out of the market. And when the market begins to rally, they're going to have to put up or shut up. And a lot of times they'll buy at much higher levels once again, and that can help accelerate the market higher. Now, shorts tend to be a little bit more egotistical as a general statement. They tend to short markets because they're high, or as I often say, they confuse the issue with facts. So the shorts are also coming in at those new highs, and they're immediately rewarded when that market sells off hard and they're feeling pretty good about their positions. And then what happens when that market rallies? They're immediately faced with a loss. Now, again, the shorts tend to be a little bit more egotistical. So what do? They hold on, again, confusing the issue with facts, and they'll end up buying the cover often much later, which will help to exacerbate that market higher. So again, the Johnny-come-latelys especially, and possibly the longer-term trend followers are knocked out. A good litmus test for me is if I'm long a market and get knocked out, it's probably a pretty good knockout move, and maybe I might want to get right back in. Somebody asked me that in this morning's webinar. What do you do if you're long a market, you get knocked out, and it sets up again? Well, you get back in, provided you really like the setup. So once they're knocked out of the market, they have to put up or shut up. So knocking them out, or when the market knocks them out, I should say, that helps clear the way for you to get in the market. It clears out those players. And then, again, they have to put up or shut up. On the short side, the shorts are instantly rewarded, and then metaphorically, they're forced out. They're sucked in and spit out. So here's a TKO, and again, we're just going to define trend by using the new highs as was programmed in here, and then we're looking for that wide range bar down, as you can see. And you want to enter if and only if you get a trigger. In other words, it rallies above the high of that wide range bar. And this, again, should be very obvious. It should stick out like a sore thumb. My initial rule said it just had to take out two lows, but the problem with that is it was very noisy and you got too many false signals. And a lot of people were constantly emailing me and saying, is this a TKO? It's like, no, it should stick out again like a sore thumb. You should see that big wide range bar down in the middle of a nice clean trend like this. Now, before we get into trend transitions or emerging trends, I would urge you to learn how to trade established trends first. Try something like TKOs, or learn something like TKOs, I should say. Get good at that before looking to trade these emerging trends. Now, with emerging trends, we're not trying to catch a top and we're not trying to catch a bottom. What we are doing, though, is we're waiting for a market to top out and begin to sell off, and we're going to use, for today's presentation, we're going to use moving averages, but we could also use a blank chart and a sharp thrust down. I call it a first thrust. And we're looking to get short at the first signs of a correction. You don't necessarily want to wait for a deep pullback, because if the market has a very little correction and then turns right back down, it's going to catch a lot of people off guard. Again, there's a psychological reason why you want to look for that first little tiny correction. And on the upside, you'll have a market bottom out. I purposely drew this as a cup and handle because a lot of times it will set up as a cup and handle type of pattern. And again, we're looking to get long after the first correction. Now, I thought it would be kind of cool when I wrote the Layman's Guide to Trading Stocks about, geez, that was probably 6 years ago, 7 years ago, maybe even longer, if I used a moving average to help define that transitional pattern. So for the pattern, the stock must make a major new low. These are buys, and then it should rally from that low. And all we're going to do to determine trend is look at that 10-day simple moving average for DaveLight. And then we're waiting for the stock to come down to kiss it. And then we're going to enter if and only if the trend begins to resume. So let's take a look at that, what it looks like on a real chart. This is actually a live example. I'm not really excited about rushing out and buying General Electric, but it is kind of cool that the software picked it up as a setup. And I've been watching this stock for a few days here. It's been coming up in my scans lately. But you can see it's making these major new lows. And then notice that you have at least 5 bars of daylight off of the lows. And this is a 10-day simple moving average. And then notice we have a buy signal here because it comes down to kiss the moving average. So your entry would be above that bar. A more aggressive entry would be a pullback type of entry where maybe you get in a little bit lower. But for something like this, I think above that bar would be just fine. So that's a live example. Now, let's talk about bow ties. I discovered early on that if a 10-day simple, 20-day exponential, and 30-day exponential moving average came together real quick and then spread out again, you often had a change in trend. So the 30 is greater than the 20, and the 20 is greater than the 10. And when those flip over to 10 greater than 20 greater than 30, it suggests that the trend has changed. So we're looking to get long after that trend change. So it's not shown on this chart, but if you back this chart out a little bit, you'll see these moving averages headed down for a long, long time. And then they came together quickly at what I call a fulcrum point. Notice 30 is greater than 20 and 20 is greater than 10. And they come together again at the fulcrum very tightly and then begin to spread out. Usually this is 3 to 4 days is what you want. I haven't looked at the code lately, so I'm not sure exactly how William programmed it, but it's probably somewhere in 3 to 6 days is what he put in there. And then you're looking for just a 1-bar pullback, and that's it. A lower low and a lower high, in some cases just a lower high. And you're looking to get long if and only if that trend shows signs of resuming. So here's the actual rules. And again, I'll give you these slides. You don't have to read these right now. It's a lot easier just to show you. Basically, if you take a look at this chart, this one's a little bit better because I backed it out. Notice that these moving averages are still headed down. And this is a long, long-term downtrend that's not completely shown. And notice that it makes a major new low. Now, I'm often asked about bow ties in the middle of a range, and yeah, they have some use. We'll look at some minor signals in a minute, but you want to focus mostly on these major signals that are coming off from major new lows, because the most amount of people will be on the wrong side of the market, or at the least, the most amount of people will have the wrong opinion about the market. And again, there's that psychology thing comes into play. And if you boil down technical analysis, forget about putting 15 oscillators on your chart. If you boil down technical analysis, we're simply reading the emotions of the market. And of course, we have to use our own trading psychology to embrace and accept our own emotions. But as you can see here, it makes a bow tie. This suggests that the trend has changed. Well, if you just sort of eyeball this, this doesn't look like a huge move, but it's actually, I forget exactly how much, that's actually like a 70% move from the lows. And then you look to get long as that trend begins to resume. And I think we triggered in this one somewhere around here. Yeah, that's what a trigger is. So notice that the moving averages flip over. They actually flip over way back here, but notice it's a little bit more obvious here. The 10 is greater than the 20, and the 20 is greater than the 10. And then obviously the uptrend resumes. And notice the big blue arrow on the chart. Now let's take a look at major versus minor signals. This is the S&P 500. Way back in 2000, we had a major bow tie signal. This is a weekly chart of the S&P 500. And then notice in 2003, we had a major buy. And then at the end of 2007, beginning of 2008, we had our first major sell. Major sell means coming off of all-time or at least multi-year highs. And then now the buy was a little late in 2009, but I will show you on with the first kiss after daylight that it actually triggered way back here, and then it was, of course, daily signals. Now there was a minor sell somewhere in between, but when I got excited about the market was way back here when we had that sell-off back in 2015, 2016. Now, this doesn't look like a whole lot, but that's pretty serious sell-off. If you're a trader who's not just buy and hold, you are a trader, by all means, this should have taken you out. I did a webinar earlier today. I was quoting Judd Dotery from a firm that Greg Morris used to manage, I think about $6 billion. And he said anybody who's kept up with the market since 2009 should be questioned as far as money managers are concerned, because they're not going to have stops in place or money management in place for when, not if, a bear market occurs. But notice that when the moving averages are in uptrend proper order, you will get bullish here. And notice that it's mostly green, almost entirely green for this entire trip higher. Now, this is the order of the moving averages, okay? I'm going to show you some daylight things here that's really, really cool in just 1 second. And I'm also going to show you how this was pretty major when you look at something like the Russell 2000. So when you have these major signals, again, this is a weekly chart. By the way, my patterns are fractal. I didn't have time tonight to get them in, but I wanted to get some intraday signals in to show you too. You could use bow ties on an intraday chart. I trade mostly stocks because stocks are more inefficient as a general statement, especially if you're trading smaller cap issues, IPOs, and things like that. But I will trade other markets. You just have to pick your spots carefully. I do trade hourly charts on the Forex. For instance, right now I'm short the euro versus the dollar based on, I believe, an hourly bow tie signal. And you can see here we did have a minor buy. A minor buy is just coming off of multi-month lows. So I don't get too excited about a minor buy. I'm more concerned about a major sell. So if we get a major sell in here, which could be setting up fairly soon, I'm going to get really concerned about the market. And the indicators will tell you that in MetaStock. So just plot the S&P every now and then and put a weekly on there. Now, as you just saw, the weekly bow tie was a little slow to catch up. And that's, again, part of the problem with moving averages. But as you can see here, we had a first kiss after daylight, major buy in the S&P 500. So this is the 2009 low. So fairly quickly, you had a decent setup. And then, of course, there were many daily signals long before that. So there's your major buy. This was a 13-year low, okay? So that counts as a major low. Now, getting back to that sell signal, that major sell signal we had in the Russell 2000, notice you had one back here that the software recognizes. But again, I'm a discretionary trader, and I made sure that the indicators were programmed so they'll catch every signal, even if it's just not a great one. But you can see these moving averages were sloppy. They were kind of all over the place. But notice here how tight they were. And notice this is coming off of all-time highs. Now, what's impressive is this major bow tie back in 2016 from the trigger, which would be right about there, the Russell 2000, which is a broad-based index, dropped nearly 18%. The media defines a bear market as a 20% drop. So for all intents and purposes, that was pretty much a bear market in the Russell 2000. Now, the cool thing about DaveLight is it will help to keep you on the right side of major bull and bear markets. Since these indicators were programmed, I've been really playing with them a lot. And one thing I've been fascinating with, if you've been coming to my weekly webinars, is you'll notice that nearly every week I've been showing this chart here. And this is a cool little indicator that William programmed for me. And this just counts the bars of daylight, not the magnitude. And when it's green like this, it means that the moving average is above, the price is above the moving average. And there was one little bar, maybe of red right about there. But for the most part, it was all green. And we had that great bull market, as you know, in the late 90s, which, God, I wish we can go back there, right? And then, of course, we had that 2000 bear market. Notice that we had all downside daylight and just one day where it intersected, but absolutely no upside daylight during that whole period. This is a 50-week moving average, and this is a weekly S&P chart, okay? And again, you have these indicators. Now, notice during this nice bull market, there was absolutely zero downside daylight. You might have had one day here, I don't remember, 1 week. But for the most part, it was all green. And then, of course, what happens next? The bear market of 2007, 2008, which ended in, March 2009. Notice that you had absolutely no upside daylight. You had one little kiss of the moving average right there, and that was it. So this should get you excited about how something very simple could help keep you on the right side of the market. Notice the bull market that started in 2009, you had one or two little touches of the moving average, and that was it. That little sell-off I'm sorry, one sell-off along the way. You had a little bit of downside daylight, but then the market recovered from it, and we had a nice run. And then the sell-off I was just talking about, where the Russell lost 18% of its value. This was actually fairly ugly in the S&P too, but notice that it began with a little bit of downside daylight, and the market did recover from that. And then since then, up until a couple of weeks ago, we had upside daylight, and then we now have begun to kiss that moving average. So notice that this drops back down to 0. So this is not the magnitude. This is just a number of days. There's not enough time to get into a lot of the things about this, but once you start playing with it, you're going to find it really cool. For instance, I've drew in lines at 100. You tend to have corrections once it gets up to about 100. I would not exit my positions just because this number is high, but I would certainly make sure I'm honoring my stops just in case the market begins to correct from those levels. Now, this is where we are now. I zoomed it in for you. This is a weekly S&P chart. You can see we peaked out here and we've come back down. We don't have any downside daylight just yet on the weekly, so there's no need to panic. But obviously, if you're a trend follower on a daily chart, you've gotten stopped out of all your longs by now. The only thing I'm seeing right now, by the way, is some IPOs. And I like IPOs because they can be, in the keyword in that sentence, trade contra to the overall market. So a couple of thoughts. I'm pretty excited about this daylight thing, and I've been playing with it ever since it's been programmed. But like anything, there's nothing magical about it, but it can be the keyword in that sentence, help to keep you on the right side of the market. And again, as I said a minute ago, when the daylight or DaveLight gets extreme in magnitude based on that little area chart indicator, you don't run out and exit everything and try to call a top. That's not what we do as trend followers. We will be a little late to exit the game, but what you should do is make sure you're following proper money management and let the market take you out when that occurs. Now, if you're interested in a crash course in all this, it's actually 6 hours. If you use the code MS16, this is the cheapest I've ever offered it, you can get $400 off. It's normally $597. If you use MS16 at TFC, DaveLandry.com/TFC, you'll get $400 off in celebration of MS16. And also, again, if you want the slides, if you want let's say it's 7 free reports, if you want access to the webinars, and a bunch of other stuff, including 4 videos from this presentation. Get the 4 videos first, watch them and see if you like them. And then if you want to take the whole course, then that would be awesome. And I support everything I do. I give it lifetime support. Also, if you buy a course, you will get unlimited upgrades. And right now, I'm rolling out a learning management system, which is pretty cool if I say so myself. And everybody I've shown so far is pretty excited about it. I think it's going to be very good to learn all of these concepts in a very structured type of way. Somebody told me recently, well, not recently, a couple of years ago, they said, Dave, you have so much great content on your website. Why do you hide it? So I'm trying to bring that to light. Yes, this is being recorded today, and Jeffrey will, or somebody in Jeffrey's office will have it published, I believe, to YouTube fairly soon. Okay. Any questions? Oh, you're welcome. Thanks for attending. Okay. Jeffrey, you want to moderate questions or?
Sure. Yeah. For those, for the person with the recording question, and if you have questions, please send them in. We don't. It's a quiet group tonight, but don't worry, Dave Landry doesn't bite hard.
I either did an incredible job or put him to sleep. So.
Yeah, one of the things is if you register for today's event, automatically Omnovia is going to send you a link to the recording, so you don't even have to wait for us to put it on YouTube anymore. It's just automatically mailed to you. And that'll happen within an hour of us leaving. So there you go. I figured out how to set that up a few weeks ago. We've been playing with it ever since. So I don't see a lot of questions coming in. I do want to reiterate to everybody that came today, thanks for coming. Again, these methodologies, Dave did such a great job of kind of helping William put them together and kind of looking at them and stuff like that. But Dave has just included them with MetaStock for free. So, and I believe in total, how many systems did we come up with? I have it right here. 7 new explorations, 6 expert advisors, 6 new templates, all just included in MetaStock 16. So thank you for that, Dave.
You're welcome. And as once you start playing with them, if you have any questions, I do answer my own email. You can go to DaveLandry.com/contact, and there's a contact page. And then once you go through that contact page, you'll have my private email, and you can ask me questions.
Scott says thank you for
welcome,
doing
Scott.
this, Dave. So all in all, yeah, these are just included with 16. What you're going to get is you're going to get the 7 explorations, the 6 expert advisors, and the 6 new templates. So hopefully that's helpful for you. One of the things I've learned over the years, and Dave kind of said this a few times, is it's so easy to kind of get over complex. And I've been doing this for about 21 years now. And one of the things that I've realized personally is those methods that are put together that are easy to understand are not only easier to understand from a discipline perspective, they're much easier to kind of follow from a discipline perspective. And in addition to that, I found this that the methods that you can understand generally have a tendency to work better as well. So that's just my experience over the years. Great job, Dave. I really appreciate the work you put into this. So,
yeah, thank you for inviting me. And I really am very excited to be part of MetaStock 16 and looking forward to hopefully more presentations in the future and doing more things. And looks like you and I might bump into each other in our world travels. So that's always going to be fun.
In any case, if you need to get the upgrade, you can give us a call, 800-882-3040. You can chat online with us at metastock.com/sellchat. As part of the upgrade, you'll get the new training videos on how to use the new scanner, the new Explorer, everything like that. And it's a really good promo. If you're new to MetaStock and you just want to try it out, I usually ask this as a full question, but I just didn't have time with everything that's going on. But if you don't have MetaStock yet, you should definitely get it. And if you go to metastock.com/DaveLandry, 3 for 1, you can get an extended trial. With that, basically the way that it works is if you pay for a month, we give you 3 months total. So again, it's just included as part of MetaStock 16. Thank you, Dave, for that.
Thank you, Jeffrey. And thanks everybody for coming today.
Well, I think that's it. Thanks for coming. Dave, thank you for your time. As always, we will see you at the next webinar.